Good evening, everybody. We'd like to welcome you to our fourth installment of our 6-Point Wealth educational series, designed to empower you with the knowledge you need for sound financial planning. In our previous sessions, we've covered Estate Planning 101, the role of an executor, and death and taxes. If you missed any of these sessions, or you'd like to view them again, we have them posted to our YouTube channel. After this webinar, we will be emailing you a recording of this session, as well as our previous webinars. Today, ClearEstate, our estate planning partner, is going to shine a light on estate expenses, fees, and taxes. From ClearEstate, we have Ellie Muir, Key Account Manager. She's our relationship manager and first line of contact at ClearEstate. Many of you have met with her already. Today's webinar is going to be led by Kim Nelson, estate plan advisor and tax specialist. She has extensive knowledge and experience in estate planning with a legal background and over 10 years of experience as a tax practitioner. Tonight, we're going to be taking a bit of a different approach as we've pre-recorded Kim's presentation since she wasn't able to be with us live tonight. But please continue to send in your questions through the question feature in the bottom right-hand corner of your webpage and continue to send those to us during the presentation, and we'll make sure to address all of them at the end. We believe that having a comprehensive estate plan is one of the most valuable gifts you can give your loved ones after you're gone. Thoughtful planning not only ensures that your wishes will be honored, but it will also result in significant time and financial savings and greatly reduce the stress on your loved ones when the time does come. It comes as no surprise to learn that settling an estate is rarely cheap. With probate fees, court fees, tax filings, the cost of settling an estate can balloon way beyond your estimates. This webinar is going to equip you with the knowledge to make informed decisions that safeguard your estate and ensure that your loved ones are set up for success when the time does come. So tonight we're going to cover probate fees and how they're calculated, tax liabilities on death and how they're paid, other estate expenses you may not have considered, and potential ways to reduce those estate expenses. As a reminder, this session is being recorded today. I'm going to now hand the floor over to Kim.
We're happy to present this webinar about estate expenses, fees, and taxes. So just a quick note as to who I am. My name is Kim Nelson, and I am a lawyer by profession. Well, I trained as a lawyer. And before working with ClearEstate, I practiced with a national accounting firm as their senior tax manager. And I also worked with CRA for a few years before that. So I've been working in the field of tax for over a decade. So speaking of taxes, you have the agenda that's up. So what we are going to be looking at are the two big ticket items that are income tax and probate fees. And after that, we'll be looking at the more granular expenses that arise after a death. And at the very end, we will do kind of an overview, key takeaways regarding everything that we have looked at. So just moving to this first slide, income tax. So if we look at the main duties of an executor before they can get to the distribution of the assets to the beneficiary in accordance with the provisions of the will, one of the things that they have to do is they have to make sure that the debts and liabilities that are owed by the estate are paid. And as we know, whether in life or on death, one of our biggest creditors and one of the ones with the longest reach in terms of collection is the CRA. So a clearance certificate, what is it? It's essentially written confirmation from the Canada Revenue Agency that the deceased and the deceased's estate has paid all of their taxes and all of the associated interest and penalties up to the date that the certificate is issued. So just a clearance certificate isn't actually a legal requirement. According to the CRA, an executor can distribute property without a clearance certificate as long as there's sufficient property in the trust to pay for any tax liability. However, without a clearance certificate, an executor is personally liable for any unpaid taxes and interest and penalties if they have distributed the estate and that there aren't sufficient assets in the estate in order to pay for those liabilities. So what that means is that the executor could be on the hook to pay those taxes if the estate has already been distributed to the beneficiaries and that they have not obtained a clearance certificate prior. So in terms of establishing that tax liability, there are three big components. So there are any prior year's tax returns. So the CRA is looking to confirm that nothing remains outstanding in terms of filings for the previous years. So, you know, especially if there's been an illness or if there's been a lot of stress in the years preceding the death, it's possible that the filing of income taxes has kind of fallen to the wayside, that they've been forgotten, or that someone just hasn't had the time or not been in the mind frame to take care of that. And so in those cases, those returns would need to be filed by the executor. And also, I'm just going to use executor instead of trustee, instead of estate trustee, or instead of personal representative. Just use it kind of as a blanket term, because I think that most people understand what that refers to. And so the executor is going to be responsible for making sure that all of those returns are filed. And we're just talking about regular returns, like the returns that we file every year, our regular income tax returns. The second portion of that is going to be filing the terminal return, which is almost like the regular tax return. So we're going to include all of the usual taxable events. So we're talking about employment income, self-employment income, investment income, capital gains, etc. But everything that has been earned from the beginning of the year, so January 1, until the date of death. Now, where the terminal return differs, or the final return differs from your regular tax return, is that there is a deemed disposition. So what happens is essentially the CRA will treat your final return as if all of the assets that you owned at that time, at the date of death, you will be deemed to have disposed of them immediately before your passing. So this often triggers capital gains, and as a result, taxable capital gains. So essentially, if there's been any growth in value on the assets that you own, which is a great thing, you will be taxed on it. There are a few exceptions. For example, assets that are transferred to a surviving spouse, we say that they're rolled over to the spouse or to a spousal trust. Those will not be taxable. So RSPs, you know, a home, any asset that's passed to the spouse will not be taxable on death. And there are also ways to mitigate that tax when it comes to certain qualifying dependents or children that were financially dependent, or grandchildren, and that qualified for the disability tax credit. So the due date for the final return is the later of April 30th, or 6 months after the date of death. And there are ways actually to minimize the taxes on death. So that deemed disposition. So I mentioned the spousal rollovers, but also there are certain assets that won't be taxable. So a principal residence, for example, is not taxable, or the gain on it is not taxable. There's an exemption for that. And, you know, if there are capital losses that were incurred during the year, those can come and they can reduce the taxes. They don't cancel them out, but they can reduce the taxes on death. If you owned shares in a private corporation, those might be eligible for what we call the long-term capital gains exemption. And I just want to address a common misconception, which is if you've got RSPs and you've designated someone other than your spouse in your RSP, the RSPs are still taxable. There's still a tax triggered even if you've designated someone a beneficiary directly. So that is something to keep in mind. And in terms of kind of mitigating the effect of the tax, there are also what we call optional returns. And so those optional returns, they can be filed and they're designed to report certain types of income. And it depends on when you receive that income and what type of income it is, or when you are also entitled to receive it. But those types of income could be put on these optional returns instead of on the terminal return. And the benefit to that is that you can access multiple deductions, or certain credits like your personal tax credit, your basic exemption, and an age credit. In some cases, you can benefit from the multiplication of those credits because you're reporting the income on these different returns. So it's important to have professionals supporting you that are not only aware of those returns, but who are also accustomed to working with them. And another return that comes up is what we call the estate return. So a taxpayer's financial activities don't stop upon death. Your investments continue to earn income, your rental properties keep earning rent, and your other assets, hopefully, continue to appreciate in value. So the estate is considered as a separate tax entity by the CRA, and the estate's income tax return is going to capture all of that income that your assets are generating, including any gains in the estate, from the date of death until the assets are liquidated. So generally, the estate is going to file its tax return on the anniversary of the date of the death. So that becomes the estate's year end, and then on every subsequent anniversary until all of the assets are distributed. And any taxes owing, or any taxes that are owing on the return are due 90 days after the estate's year end. So basically, each estate return covers 1 year. And the estate return is required to, again, report taxable income. And depending on the timing and on the size of the estate and the assets that are held in the estate, if it's a fairly simple estate, then the T3 can be the first and final return for the estate, provided that all of the assets have been liquidated and distributed. So in the cases where that is possible, it is definitely advantageous to wrap the estate up as quickly as possible, as that reduces the costs that are associated with the filing of obligations over time. And as we talked about the optional returns that are available in terms of the final return, so there are also planning opportunities that are available through the estate return. So there's an election that's available within very specific parameters, whereby an estate's losses can be carried back to the final return of a taxpayer if they have gains in that final return, which they may, given the deemed disposition rules that I mentioned earlier. So it's really important to have an advisor that not only knows how to do tax returns, but that is very aware of the different opportunities and the different mechanisms that are available, and that's just accustomed to preparing these types of returns to make sure that you are able to, or your estate is really able to benefit from the planning opportunities that are available. Oh, and just to mention that as it says at the end of the slide, and as I mentioned, there is a tax preparation cost involved in producing all of these returns, so that should always be borne in mind. Okay, so now we're going to look at probate. So what is probate exactly? I don't think that anyone's, I think that very few people are actually very, very clear on what it is. And so probate is really the judicial or the court process to validate the estate representative and their authority. And it also validates the will as the original. So if there's no will, obtaining probate basically is the court confirming the appointment of whoever has applied to be the executor of the estate. So at the end of probate, something is issued that's called a certificate of appointment of estate trustee. So why have probate if you have a will? So you'll probably need both because they serve two different purposes. So with your will, you're essentially controlling how your assets will be distributed. But when the executor is trying to execute those wishes, they're going to have to deal with third parties. And those third parties will generally require probate to deal with and to accept the instructions from the estate representative, because they don't want to be responsible for dealing with someone who wasn't legally enabled to represent the estate or to transact the assets of the estate. And when it comes to your executor as well, it's important, it's a protection for them, because if later on there's any kind of question as to whether they appropriately distributed the estate, or whether they were actually legally authorized to distribute the estate, they have that certificate to prove that they were validly appointed. So the third parties that will generally require probate will be, for example, financial institutions. So the bank with the bank accounts, the financial institutions that are holding investments. The land registry would also require probate because, whether it's to sell real estate, so a home, a cottage, or whether it's even to transfer title, it would be necessary to go through probate. And also if you have maybe any valuables or collectible items, and for example, an auction house becomes involved in order to sell those items, they're going to want to know that they're dealing with someone who can validly authorize the sale of the assets. So those are the reasons for probate. In terms of the assets that are subject to probate, we're looking at equity in real estate that's held individually or through tenants in common. Now, tenants in common, there are two ways of holding property with someone else. There are other ways, but there's tenants in common and there's joint with right of survivorship. And so joint with right of survivorship, essentially both parties kind of own 100% of the property, to put it in a very simple way. For tenants in common, each party owns their part of the property. So if you're holding a property tenant in common with someone else equally, that means you own 50% and the other person owns 50%. So on death, the person who's past 50% would pass through probate. They're considered, they hold it individually. Individually held financial accounts, so accounts that aren't held jointly with someone else. Personal effects and vehicles, your business interests, for example, if you own shares in a private company, those would also typically go through probate. And anything that's like registered plans or life insurance where there isn't a designated beneficiary that's been named. So those pass through probate. I'm going to talk a little bit later about some ways that you can reduce probate and some things that don't necessarily have to go through probate. But for the elements or for the assets that do, probate is basically calculated, the calculation varies by province and it's dictated by provincial legislation. So for some provinces, like Manitoba actually doesn't have any probate fees. There is a filing fee when you're requesting probate, but there is no longer, since 2020, I believe, there's no longer probate fee. You've got Ontario, which is coming up here on the slide. So for assets, for estates that are worth less than $50,000, there is no probate calculated, no probate fee. However, there is a probate fee of 1.5% on the portion of the estate value that's in excess of $50,000. So when I'm talking about the value, the estate value, we're looking at the gross value of the estate at the date of death. So the only real reduction is if there's real property in the estate, then the value can be reduced by any encumbrances on the property. So we're talking, for example, mortgage. So probate is also what in Ontario, at least, we call the estate administration tax, which is not the same as income tax. They're completely two different layers of taxation, and one actually has no effect on the other. So it's important to know that. Given the assets that I just described, there are some that may not be subject to probate. So assets that are joint with right of survivorship. So you hold these assets with a partner and or even with another person. If they're joint with right of survivorship, then the asset passes directly to that person and it passes outside of probate. There's a misconception when it comes to bank accounts specifically that that are held joint with right of survivorship. When it's with a spouse, there is a presumption that the spouse becomes the full account holder. When it's with adult children, there is no such presumption. So the banks will not necessarily, for example, if we're talking about a bank, assume that your adult child becomes the owner of that account. There has to be a clear intention stated with the bank or clarified with the bank that the account is meant to belong to the adult child. And there are several reasons why having an account that is joint with right of survivorship with an adult child may not be beneficial. But for example, for during life, for purposes of if the child has creditors or if there is a breakdown in relationship, for example. So the assets that are in that account that's held jointly might be available to the adult child's creditors. And even on passing, just making sure that those assets are distributed to the estate, if that is the intention, or not, depending on how you want that, the amount that's treated in that joint account, that should be very, very clear how you want that dealt with. So probate tax is paid to the provincial government, if I hadn't mentioned it before. Now, some of the other ways that some other assets that can pass outside of probate are, for example, we saw in the slide registered plans that are designated to the estate or where there is no will, where the estate is intestate. Those would normally pass through the estate, but if you name beneficiaries in your registered plans, your RSPs, your RIF, those will pass outside of the estate and will go directly to the designated individual. And in Ontario, there are a couple of specific exemptions, or not exemptions, but specific exclusions to the assets that pass through probate. So for example, if you have a corporation, you have shares in a private corporation, we're not talking about like shares in stock or all of that. We're talking about a private company like your business. Those interests could go into what we call a secondary will, which will not have to pass through probates. And also certain real estate that was, this is more rare, but real estate that was held for a very long time, like 70s or 80s when the land registry was still a paper. So properties that were purchased then and that were not transacted on, so there was no selling, no transfers, no transactions on the property since it was transferred to the digital register, those may also be able to pass outside of the estate. But these are specific cases, and it's really important to have the proper advice in terms of how to structure your estate so that these elements do not pass through probate and that it's done correctly. That being said, because of these exemptions, for example, probate won't necessarily be required every time someone passes. So in the case, for example, of a couple, if everything is owned joint with right of survivorship, if all of the registered plans are passing directly to the spouse, then there's no necessity for probate. There can be reasons why we might want assets to pass through probate. It's not that we want to pay the taxes, but we do want them to pass through the estate, and hence they will be subject to probate. So for example, if you're passing your RSPs along to a party that's not your spouse. So in that case, those RSPs will be taxable because of the deemed disposition on death. And that creates a tax liability that your estate will owe. Now, if there are no assets that are passing through the estate, then the estate does not have the funds to pay for the liability that's triggered, then what's unfortunately going to happen is that the CRA will go to the beneficiaries who have received assets and claim the taxes from them. So that can become very problematic. So there are some cases where you might actually want assets to pass through your estate to deal with tax liabilities. So the important thing is to really look at things holistically and to be really well informed so that you can plan according to the overarching needs of your estate and not leave your beneficiaries with some unexpected burdens or surprises. So there is also another component when we're looking at what happens when there is a death. In terms of expenses, there are also these more granular expenses, but that are common to most estates. So in terms of the immediate expenses, we're going to look at funeral expenses. So unfortunately, because of the process of probate, if you do have to deal with probate, there's a timing issue, right? Because probate takes a certain amount of time, and while you don't have probate, banks might not want to deal with the executor. So the funds that they need in order to deal with the expenses might not be readily available. In some cases, banks are prepared to, the executor can speak with the bank, and some banks may be prepared to either pay for the funeral expenses directly, or they can allow for that amount to be withdrawn. But that should be discussed, and it's not necessarily always a given that that's how it's going to work in practice. There can also be medical expenses. So if there was a long illness prior to passing, there can be many medical expenses that are left over and that still need to be dealt with. Repatriation, for example, people who have, either have passed on vacation or who have properties elsewhere, and maybe they're at that property when the death occurs. And so in that case, there are fees for repatriating the body home. So again, these are fees that come up, and the executor might not necessarily have immediate access to funds in order to be able to pay for these expenses. And actually, even probate is something that normally is supposed to be paid at the time that the application is made. Again, in that case, banks may make exceptions, or you can actually file an application to not have to pay the probate fees right away, but that's also time consuming. And so it really is important to map out beforehand how all of these immediate expenses are going to get paid and how things can be set up to allow the executor to access funds in order to be able to pay for these more immediate expenses. And so another category of expenses that come up are debts and maintenance. So another one of your executor's main duties is the safeguarding, the protection, and the investment of the assets pending the distribution to the beneficiaries. So debts that are owed while alive are still owed on death. And so the executor is going to have to draw up an inventory of the expenses that need to get settled by the estate and settle them to the extent that is possible to make sure that no property is lost because of impayment, for example, of amounts that are due. So if in that vein, in terms of paying debts and preserving the estate, if there are certain expenses that don't need to continue, that can be canceled, memberships, or for example, reducing how much the lights are on, reducing electricity fees, reducing any utilities that can be reduced. If you're looking at investments, are the funds invested in a way that there are really large or larger fees that are attached to the investments? Are the investments prudent? The executor will be looking at how to minimize expenses in order to really preserve and protect the assets of the estate. So, for example, if we look at, there will be ongoing maintenance for the preservation of property, for example. So if we're thinking about real estate, maybe there's a cottage, or maybe the house is empty after the passing. So there has to, the executor will make sure that there's adequate insurance on the property. If the property is vacant, they will have to notify the insurer and the insurance company may require regular checks on the property to make sure that the property, that nothing's happened, no pipes have burst, that there isn't a problem with the property. They may require a vacancy permit also. So that could be an added cost in terms of insuring the property. And so there are several different expenses that need to be taken into account. Making sure that property taxes are paid as well would be important steps that the executor needs to take in order to ensure that the property is essentially safe and that it's well maintained. There can be professional services as well. Oh, and just referring quickly to the slide, there can be repairs that need to be made on the property, which would also incur expenses. So in terms of professional services, there may be need for appraisers. So depending on the type of assets that are held by the estate, appraisals may be required. So on real property, on if there are personal effects, for example, that may have been undervalued or overvalued, it's really good to have an appraiser come in and determine the actual value of what is in the estate. And it's also important to make sure that everything that needs to be included in probate or in the probate application or in your income taxes also does get included. Do you really need an appraisal? It's really the only proof positive that the executor has to confirm the value of, for example, real estate. So a lot of people will try to get a realtor opinion of value, which is very attractive, typically because it's free. However, if there's any kind of a challenge, if a beneficiary challenges the value, for example, then the realtor opinion of value will likely not stand up in court because it's not a certified appraisal. And neither are municipal valuations, by the way, which are generally undervalued. As I mentioned, it can also be good for personal effects. And another reason, aside from probate and income tax, is if you're distributing assets and it turns out that something has, one of your personal effects has a significant amount of value, it can be important to know that in order to make sure that that is taken into account if, for example, an equal distribution of the estate was intended, or just to equalize with other distributions that are being made. But there's a cost to obviously getting an appraisal, and that can range anywhere from $500 to thousands of dollars, depending on how long it takes the appraiser to assess, and depending on the type of asset, and depending on the location, for example, of the asset. There are also realtor commissions, so self-explanatory. On the sale of a property, you can have fees that are associated with property managers. So often, like for vacant homes or for rental properties, you might need a property manager to come in and ensure, again, the security of the property, to make sure that all is well, that no repairs or any kind of maintenance is needed. Auctioneers, again, looking maybe at personal effects or collectibles, etc. It might be a good idea to have an auctioneer sell some of those assets, or even, auctioneers can be brought in to, instead of parsing through things, where an estate sale can be arranged. And that comes with a cost. We also often see that there are home cleaning services or clear out services. So again, making sure that the house or the property is clean before it's put up for sale or before it's transferred. And clear out services will sometimes come in, and essentially they do a bit of the grunt work of sorting through the different property, looking at what has value, what has less value, what is worth selling, what should maybe just be disposed of, or what maybe can be gifted to charity, for example. So they come in and kind of do a parsing of all of the assets, which can be very valuable in terms of saving time, in terms of clearing the estate. Transfer of title, property transfers, there's a cost associated to that too, even if you're not necessarily selling the property. the property will have to, the title will be transferred if you're giving the property in kind as opposed to or as opposed to having your estate sell it. So there are fees associated with that, and associated with, for example, having a lawyer come in and take care of title transfer. Which brings us to fees like lawyers, for example, not only for title transfers, but lawyers can charge also for filing for probate on the estate's behalf, and those fees can be, around $2,500, or they can be a percentage of estate assets. So those are additional fees that may come into play. And unfortunately, there are sometimes cases where there's litigation regarding the estate. And so lawyers' fees will become applicable then. And by the way, it's always a really good idea to discuss what your intentions are regarding your estate with family in order to minimize the risk of that kind of thing. And of course, there are other fees that will come into play. So an accountant's fees, for example, for tax preparation, the final return, the estate returns, and also other types of assistance, for example, ClearEstate services. So, we, for example, offer packages for different types of estate needs. So either when it comes to settlement, so stepping in as either your executor or supporting your executor in terms of navigating this whole process. And we also offer planning services. So to get on the front end of all of that and try to minimize the work that needs to get done, or minimize the complexity of what happens at the time of settlement. So all of that to say that it's really, really important to engage the right professionals who are prepared to address the specifics of your estate in a way that makes sense for your family and for your estate. Individuals or professional executors such as ClearEstate who do this regularly and who are really accustomed to the particularities of this kind of work. Lawyers and accountants are able to do this work, but they don't necessarily do it all the time or do it very often. So it's always good to seek the right expertise with the specific knowledge and to just be informed, which is part of actually the purpose of these webinars, is to make sure that you understand as much as you can about this process so that you can start having discussions with your family and with your advisors to make sure that the needs of your family or the people who you are leaving your estate to are not only met, but that you're not leaving them with significant burdens or headaches. So ClearEstate does this on a daily basis and has the internal resources and external resources if need be to deal with this. And so the next thing that we'll just move on to is executor compensation. Your executors are entitled to be compensated for the work. It is a lot of work. And as we've seen, there's a certain amount of complexity that can be involved. And so normally the amount that an executor is entitled to, you can provide for it yourself in your will. And there's also legislation in the different provinces that kind of gives parameters in terms of what is considered reasonable compensation for your executor. So if you go ahead and make the decision, you can indicate that in your will. In terms of what's considered reasonable, like from, for example, in Ontario, generally about 5% of the value of the estates is considered reasonable executive compensation. So if you don't provide for how much your executor will be compensated, the executor will need to go and obtain approval from all of the beneficiaries in terms of how much they can take in terms of compensation. And if the beneficiaries don't agree, then the executor is going to have to go to court in order to obtain approval for the amount, which is an additional expense in terms of fees and in terms of time. So it's good to think of that ahead of time. And as I mentioned, it is quite an important amount of work, the process of settling an estate. has estimated to be a few hundred hours, and it can take an extended period of time from 4 months to 18 months, and maybe even longer depending on the complexities of the estate. So executor compensation is definitely something that should be part of your planning, the thought as to whether you would like to offer your executor compensation. And also, it's important to mention that executor compensation is taxable. So sometimes what is possible is, instead of offering compensation directly, it is possible to leave your executor a gift. So that does not have tax implications, and it's a way of compensating them for their time and for their work. So we've spoken about a lot of things, and the key takeaways are dying can be expensive. So it is really important to understand what expenses will be applicable at the time of, subsequent to a death, and to be able to start looking ahead of time as you're doing your estate plan as to what efficiencies can be implemented or developed in order to reduce those expenses. So tax liabilities, probate fees, and the other expenses that might come into play. Plan for how your estate expenses will be paid. So unfortunately, it may not be possible to have no tax liability or no probate fees. It might not be possible to escape expenses. And so it is good to give thought to how will liquidity be provided to the estate immediately in order to, or to the executor immediately, in order for them to be able to cover the immediate expenses or the liabilities that need to be dealt with. There are different ways. There's leaving life insurance directly, for example, in order to fund those expenses. So it's important to take those into account. And finally, just plan for what professionals are going to be involved. And again, it's great to start earlier rather than later, to be planning rather than having your executor need to worry about this once the estate needs to be settled. So really having advisors that understand your situation well, that understand your wishes well, and that are able to help you design your estate plan in a way where it is efficient and in a way that does not leave too significant a burden on your beneficiaries and on your estate. And just also ensuring that your loved ones also have the right support that they need, because it is a difficult time, and it is a gift to be able to allow your beneficiaries to find the support that they need to not have to worry about these more administrative and technical things when it's already a difficult situation. So it's about structuring things for a successful estate transmission and for the people you leave behind's peace of mind. And so that concludes the webinar. And if there are any questions, if there are any more specific items that you would like to be addressed, please always feel free to reach out to ClearEstate, and we will be happy to address those concerns with you and to support you.
Great. Thank you very much, Kim, for sharing that message with us. Again, that was a recorded message. Kim couldn't join us live, unfortunately, this evening. But I want to thank Kim for sharing her insights and thoughts when it comes to managing expenses, fees, and tax elements of an estate. I think she did a really good job in outlining some of the elements of the probate process and the role of an executor and some of the responsibilities that they have as well, too. We now have some time for questions. So again, as Mike had mentioned, there's a question button here on the app on the bottom right-hand corner. So if you have any questions, Ellie, I think you've got a few that have come in, but I'll take one that did come in during the conversation that came in earlier. And the question was, is there a capital loss in the final T3 return? Does that loss get reported as a negative income on the schedule of income? It's not a straightforward answer. Generally speaking, capital losses are only used against capital gains. So again, if this is a T3 filing, generally speaking, your losses only go against your gains. But maybe the question could be, is there a capital loss that's happening in the final tax return? And in some situations, a capital loss can go against other income in a final return. Our suggestion would be, obviously, at the time of going through this particular situation, that we would seek out, obviously, professional tax help on that, just to make sure. But again, depends on whether we're talking about a final return or a T3 return, would kind of help prompt that response.
Yeah, that's right, John. You're going to find so much of the time that it's really dependent on all of the different factors within the situation. So we love that you're asking questions like this. I hope you can see that we have people here at ClearEstate like Kim, who would certainly be able to answer that question for you if she had a good sense of what the assets were, what the numbers are when it comes to tax time. I do have some questions, but I'm still going to encourage others to submit questions here for us. You can see on the screen as well that I'm just sharing the contact info for your advisors and how to book a consult with us. But let's go over to questions. The first one I have here is what if a loved one passed away years ago and things weren't dealt with? So this is something that does happen quite often. Part of what ClearEstate does is help executors, right, with settling estates. Not only do we plan estates efficiently, but we do a lot of help for executors. And what can happen if you don't settle an estate quickly is that expenses and liabilities can continue to increase over time. So it is really worthwhile to make sure you're dealing with an estate as soon as you can. And if it's something you're finding difficult, get help for it. Another thing to consider if you don't settle an estate expediently is other family members who may have been beneficiaries may also have passed away. So this can leave multiple estates to settle and you have to untangle them in the right order. So that is a great question. Another question we get a lot is, are death benefits taxable? So death benefits, that's something that you can get pretty quickly after someone passes, just to start helping with the expenses of the estate. They are considered taxable income to the estate. So that is something to keep in mind. Another reason to always make sure you're keeping very good records when you're in the process of settling an estate. Looks like we have a question that's come in from Paul. So for RRSP or RRIF, when there is no spouse, but the beneficiary is a child, I know income taxes are due in the final return, but is the value of that RRIF calculated as part of probate fees or not? So when there is a named beneficiary, generally that means it's going to fall outside of probate, right? It doesn't need to go through. It just ends up in the hands of the named beneficiary. So, yes, there's going to be some income taxes, but you're avoiding that extra probate fee as well. And so wherever possible, do make sure you're naming a beneficiary. Thanks for that. Anything to add there, Mike or John?
I guess the only thing I would add is, again, not knowing the age of the child and whether they're dependent. Again, in some situations, obviously there's different treatments in regards to rollovers to adult children where they're deemed disabled or something like that. So again, the question just says child. We don't know the age, if they're dependent, stuff like that. But your response was right in the sense of not knowing that yet.
Okay.
The other thing I would maybe just mention, it's not necessarily a question coming in, but it's one that we're starting to talk to our clients about just over the last few weeks. And that is, obviously, the budget came out recently, and Kim didn't really mention it here, but obviously she talked about the deemed disposition at death. Generally speaking, the new inclusion rate that's been introduced for capital gains here in the proposed budget, for individuals, not corporations or trusts, but for individuals, there's a fairly high threshold at $250,000 a year before you have to pay that higher inclusion rate. So it's gone from 50% to 66 and a third for those that are going to generate more than $250,000 in capital gains in a year. So generally speaking, if you're filing your tax year to year, it's unlikely you'll get to that. There'll be obviously some exceptions. But that situation or status might change in the year of death when a much larger deemed disposition takes place. So when you're talking about a large non-registered portfolio, or in some cases where people have second properties, whether it's a cottage or a rental property. So that is something that we're talking to our clients about right now in some of the tax planning strategies on maybe getting ready to try and manage that a little bit easier or better going forward.
Okay, thanks for that. Another question. It looks like, by the way, Paul clarified that it's an adult child with no disability. So thanks, Mike, for answering him there. When it comes to different provinces, so which province assesses probate fees if assets are located in a province where the deceased did not reside at date of death? Okay, so if you're outside of your jurisdiction, Kim covered a bit about some of the fees that can be incurred when you're not at home when you pass. But for this question, formal probate processes may need to be done separately in the provinces where the deceased held assets. So for example, the probate process in Ontario, which was the deceased province of residence, and the ancillary probate process in, say, Manitoba, where the deceased held another asset, for example, maybe a hunting cabin or something like that. Valuation of the property needs to be done by someone who's knowledgeable about properties in that province or area. So going back to what Kim was saying about getting an appraisal, that's something that you can't challenge very easily in court. It's going to be the law of the land and a word that the courts are going to trust when you get an appraisal. And it's important who you choose to do those appraisals, right? They've got to be somebody that is provable as someone who has expertise within their area.
I think another one I'll just maybe bring forward that it's one that myself, Mike, and Carmela and that would deal with from time to time with clients is really when there's a large registered plan part of the portfolio and the beneficiaries are now not spouse related. Those are ones that obviously take a little bit more careful planning and understanding as well too, because as Kim mentioned, there is a spousal rollover benefit that you get on a tax-free basis when rolling a registered plan, whether it's an RSP or RIF to a spouse. But if it's going to, say, an adult child at that point in time, obviously we have to be mindful of considering what those tax considerations would be. That beneficiary will generally get the benefit of the registered plan, but there are still taxes due on that final tax return. And if there's not other life insurance policies or non-registered assets that are there to cover that, again, that's something that, again, some counsel to the executor on how that gets distributed up front, and that conversation with those beneficiaries need to take place, because I've experienced a couple of hiccups, I'll just say politely, where distributions have taken place too quickly, and then obviously that tax bill is due, and a little bit of scrambling has to take place to kind of get money back from beneficiaries. So to try and avoid some of those situations, some of that planning and conversation with professionals need to take place on those registered plan assets.
Mm-hmm. You don't want to go up against the wrong arm of the CRA, right? They're gonna, right. They're usually going to win. That is true. So yeah, even though it's a long process, you still need to take your time to make sure that you're totally clear before you give out to beneficiaries typically.
I don't see any more questions. Do you have another question, Ellie?
I have one more that does come up often, which is that are the probate fees based on the estate value after expenses are paid off, including executor compensation? So just because she went over a lot of those points, the answer is probate fees are based on the date of death value of the estate asset. So she was talking about that deemed disposition, right? The only thing you can deduct is encumbrances on real property. So for example, the mortgage. So the probate fees are calculated on the value of the estate on the date of death, regardless of what the future executor compensation will be or other expenses.
Thanks, Ellie. On that note, we'll wrap up this evening. I want to thank Ellie for helping us put this this evening together, and for all the work that you do for us. For those who don't know, Ellie is our relationship manager with ClearEstate and has been working closely with us, in addition to many of our clients, in starting some work with ClearEstate and helping to update and complete their estate plans. So thanks, Ellie.
Yeah, you guys you have a very nice group of people as clients. It's always a pleasure to meet with one of them. Yeah.
That's good to hear. This was our fourth installment of our educational series, as Mike had mentioned, centered around the topic of estate planning. A replay of this recording will be on our YouTube channel in the next week or so. So if you want to replay this again or share it with a friend or family member, by all means, please do that. We've had really good feedback on these sessions that we've been doing over the last few months, so we appreciate that. We're going to continue with our next series of educational planning events like this. Next one will be in the fall, so we'll take the summer off, and then we'll come back in September with another topic for everyone to kind of hopefully get informed on. So finally, on behalf of myself, Michael, and Carmela, I want to thank our clients and their families for attending tonight's session. If there's any questions that you still have, by all means, please feel free to reach out to any one of us, and we can kind of bring it to a more personal situation on your situation to answer those questions and help you along with that. So on that, I want to thank everyone and have a good evening.
Good night.
Thank you. Good night.